What's going on, everybody? You're welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, you're in the right spot. On the Gray Report, we're breaking down everything you need to know for what's going on in the multifamily industry, real estate, and the economy. We've got some great reports. I'm looking at AP, New York Times, National Association of Realtors. Matt Bosnagel's here to break it all down for us. We got to make sense of this crazy housing market. Let's get into it. All right, everybody, welcome back to the Gray Report. Matt, crazy housing market, a lot of opportunities, a lot of uncertainty out there. We've got some great articles. Hey, but first, if you are a multifamily investor, you want to make sure you're subscribed to the Gray Capital YouTube channel. But also, you can get the Gray Capital, these same episodes via podcast. So wherever you're getting your podcasts, Spotify, Apple Podcasts, Google, check out the Gray Report. We love a review and a comment, whether it's here on YouTube or elsewhere. And if multifamily investing sounds like an interesting prospect for you, hop on over to check out the Gray Fund. If you're an accredited investor, graycapitalllc.com/Gray Fund. Enough of that, Matt. What's up? What's going on? How's your week been?
It's been pretty good. You know, this upcoming newsletter is going to be the 100th newsletter. So 100 straight weeks.
100 straight.
I'll celebrate it when I can.
100 weeks in a row, delivering the most up-to-date and thorough analysis, I believe, of the multifamily industry that you could find.
I thought about it, and I really like doing it, and I can't find any other better alternative.
No, some people have reached out to me seeing how we do it because they want to do the same thing. They can't figure it out, but I got another couple emails yesterday. I'll forward to you, Matt, of people saying that they're using the Gray Report. Commercial real estate broker out in Las Vegas said that the Gray Report is her main source of information, forwarding it to clients, and a great tool. And that's
you know what? I this is half joking, but I think my brain has wired itself to really comb through all this stuff, and so I kind of get in the zone sometimes, and it's fun.
That's good. Somebody's got to do it.
That's right.
Okay.
I'll do it.
All right, so let's talk about this first article from the Associated Press from AP. Rents reach insane levels across the United States with no end in sight. Wow, Matt, that sounds scary. What's the deal? What's going on with these rent levels?
Yeah, so last week we had an article from the Washington Post on investor interest, a kind of just like a mainstream take. And there's a couple ones that I want to talk about this week. I pointed to a paragraph near the end of the article that had some speculation about the impact of rising rents. This week, here's another one, an article from the Associated Press that speaks to rent increases directly. Yeah. And they call it insane. And this one had a lot of attention. It was displayed pretty prominently. Yeah. And I think that we've seen similar patterns and features in articles that address rent and housing affordability. And I'm going to summarize these patterns a little bit. So they start with a personal perspective on the issue. This is all these mainstream articles. It's like so-and-so is experiencing this problem. And then they expand it to this idea. Stories like these can be found throughout the country. And then they invoke inflation. They reference the record low inventory, and they return back to a personal perspective, tie things up for some closure.
Yeah, it seems like a pretty good model to write an article.
It is funny, but like I think it's written that way because it works. It's what people expect, and I don't fault them. And actually, as I was reading this, I was expecting, here's another one, but there's actually some good stuff in here and some really interesting ideas, and backed up by some credible sources. So I give this article an A. Just as a teaser, but yeah, I really like the issue.
Is it any surprising? Last year, all the talk was lumber and steel, and surprise, now it's rents.
Yeah,
is it? Should it be a big surprise? We were saying last year talking about it when we were saying, why isn't anybody talking about this? The amount of growth that's going on. Everyone's again focused on lumber and maybe single family home prices, while rents were moving. It just wasn't gaining everyone's attention. Now it seems like it's at the focus for a lot of folks. And another example of whether it's inflation or you talk to some people, it's the greedy corporations and these big investment companies going in there.
And that's another element of an article like this. They find someone to kind of hint at maybe it's their fault. And then they also hint at a solution, which involves some fun stuff like rent control. But I was thinking about this. If rents are insane at this point, then what is the stopping point? And I mentioned this, in previous weeks, like when are renters going to be unable to pay, and what are the signs that they are going to be unable to pay? Is it going to be seen in absorption numbers? Is it going to be seen in rent payment kind of delinquencies and late payments?
Yeah.
So I went and I checked. The NMHC has a rent payment tracker that actually they stopped running it. They stopped keeping track of it in December 2021, but it did record a slight decrease in the rental payment rate compared to the previous year. The Household Pulse survey, which was a pandemic-related data gathering effort, also records a slight increase in the amount of households that are not caught up on their rental payments compared to the previous survey period. So that one stopped around February 7th. I think this is way too soon to say that rental payment rates are trending one way or the other, but it's always worth paying attention to, I think. And I really am. I'm interested in the potential correlation between rent payment rates and rent growth. I don't know what your take on that is, or whether that's something that you watch. But it seems intuitive that if rents are too expensive, well, one, they won't rent anymore, or B, like they're going to miss their payments because that's just this hard stop to rent increases.
It comes down to really doing the basic operational basics of is really under or qualifying your prospective residents and tenants of these properties, because you shouldn't be leasing to people who can't pay.
Okay.
Usually, general rule of thumb in the industry is your take-home pay needs to be 3 times what your rent is, and that's really the max. Any more than 30% of your take-home pay wrapped up in housing is considered housing burdened.
Okay.
And so, in most landlords have a rule you have to be making 3 times your rent.
Yeah.
And if not, you shouldn't lease to that person. And ideally, it's closer to like 20% or so. Now, if someone loses, a job, if something happens, there's only so much that you can do about that, and you try to work with that individual. But if you're qualifying your tenants on the way in, there shouldn't theoretically be that big of a problem.
Yeah.
Now, some groups will not be as strict, or just they're focused on occupancy, and they're like, sure, we'll sign a lease to anybody who walks in the door and is willing to put down, a deposit. And,
okay, that's interesting, because that was just an idea that I had is this potential correlation, but you think that's maybe more of like a property management thing, or just like having the systems in place to run it properly rather than a bellwether that you should reduce the rents.
I think it's a lot of different factors. I mean, so we're sort of unwinding from this eviction moratorium paradigm that we've been in. Now the eviction moratorium sunsetted in what was July last year, but still a lot of local municipalities and counties where you actually go to court for an eviction, a lot of justices have been very hesitant to proceed with evictions. Depending on where you are, you're still doing it. I mean, we had a handful of evictions we had to deal with the past couple of weeks. But some of them, we they were dragged out an extra few weeks because, just the judges are, they're very much.
They got a lot to do right now.
well, they got a lot to do, but they're like, okay, the pandemic, coronavirus, so we're just giving everybody a break. Now, there's also an incredible amount of rental assistance that's finally getting out, which has been helping things. I think like in Indianapolis, I think they've gotten over $100 million out of rental assistance over the last year or so, and so that should be helping things. But I think as we start to normalize a little bit, I think we're seeing some things finally work their way through the system of maybe there are some people who, signed a lease that they should not have signed, or they shouldn't have gotten the application. They shouldn't have been accepted, or they lost their job at some point in the pandemic and they've been kind of floating by, and, they weren't able to be evicted. And now finally, they've gone through their savings and they don't have any more savings, and they're just kind of at the end. And it's still a tale of two cities, though, because you have some renters who are making more money than they've ever made before, and they can easily, they want something nice, and they can pay that premium. And then there's some people who've been just left behind because they left the workforce and they just haven't re-entered the workforce or whatever it is. So I think it's a combination of a lot of different factors.
Okay, and I think what really makes sense is how you deal with it. And I do think it's interesting that, it does seem like more like a having the right processes in place rather than seeing it as a sign to maybe reduce rents. Period. Yeah. There's lots of different levers that you can pull to prevent it in the future and to kind of deal with it as it happens.
Yeah, I mean qualifying your residence is that's where it comes down to.
Yeah,
and you can have problems with making sure your whole staff is doing the qualifying the right way. You've got checks and balances, making sure nothing's slipping through the cracks. Mm-hmm. But yeah, I think operations really can solve a lot of these problems. Okay. And operations and communication, the right management practices, because or maybe if you have residents that aren't paying you, let's try to figure out what's going on, and work with them. Because there's a lot of like we mentioned, there's a lot of programs out there right now that to help people who can't afford or dealing with something. There's not a whole lot of excuses not be able to pay because one, there are more job openings than there have ever been.
Yeah, that's what I was thinking.
It's rental assistance.
Yeah, okay. So the real hard stop would be if the economy is not doing very well, and there really doesn't seem to be some huge damper on the economy at this point. I don't see any more waves, although I probably invoked one just now.
Yeah, I think S&P 500 is in correction territory.
All right.
So, I mean, if you're looking at like the stock market side, I mean, a lot of this is just, global, macro, Russia, Ukraine, Federal Reserve, and which all can affect the economy. And, if the economy crashes and people aren't hiring anymore or laying people off, that's not good for anything. That's not good for apartments. No, we had Noah Stone on last week from Berkadia, who kind of took us through a lot of these examples. And it's if you didn't catch the episodes, it's worth going back and listening to, because we played through a lot of these scenarios.
Yeah.
And, he had a, relatively rosy view, but it was all backed by really solid data that just the demand for housing is so strong that it'd be kind of hard to knock multifamily kind of off its track of growth, or at least it's going to outperform other
and that's what,
areas.
And that's what, returning to the AP article, it does have some interesting information on vacancy, which is something that we'll get to later when we're talking about the NAR report. But basically, vacancy is the lowest since 1984. And it also has some numbers on shortfall of housing supply, which is the difference between housing supply and housing demand or absorption. This has expanded by 51% since 2019. And it was already out of balance in 2019 significantly. And so it's just become even greater. And then it has a nice little figure. 18.2% of U.S. purchases were made by businesses or institutions in Q3 2021. That last one.
Yeah, it's 80-20 rule.
That last one I'm not sure.
Principle.
Yeah, exactly. That maybe you could just apply it anywhere.
Yeah, is it? It is.
I think that last one. I don't know if that's the latest data, but it does. They did say it was a record breaking amount of purchases were made by businesses or institutions. We've covered the competition between homeowners and investors, and I think that I've heard nothing that would persuade me that it isn't more that homeowners are willing to bid more for a house than investors.
It's interesting having conversations with people who aren't focused on the housing industry. If you go on the internet, especially like if you go to a place like Reddit, into any like market sub, so like every city has their own like subreddit, and especially in these high price markets, people are talking about housing, whether it's single family homes or rentals or whatever. Some investment company came in and is renovating and they're raising rates, and they're really evil. But one consistent theme I've seen of people just being frustrated, and they're blaming the cost of housing on investors buying homes, and people saying,
you gotta find someone to blame it on.
You gotta find somebody to blame. Exactly. It can't be us. It can't just be collective. It has to be somebody. But they're saying, if I sold my home, I would never sell to an investor or an investment company or a corporation or an entity. I'm only going to sell to a family. And what if we could actually pass a law that would like prohibit only like families buying homes?
Well, but then there's those weird edge cases where these buildings in New York City, these residential buildings are empty because of foreign investors or something like that. It's like there's bugbears, there's like boogeymen out there of investors.
But they're saying other investors are driving the price up.
Yeah.
But it's like, okay, explain how that would work.
Yeah.
Like, okay, one, if we're talking about single family homes, the way that many investors do it is they buy it as an individual and then they quit claim it to an LLC. Okay, so how to figure that out. You're basically saying who's allowed to buy something and who's not. You're giving families a preference over other individuals. Like, who gets to make the decision of you get to buy that, but you can't buy this, but I can buy that, but you can't buy this. Like, you're putting those types of controls on the economy is absolutely insane, and is going to ruin the housing market. And at the end of the day, you're selling a home. That's a direct benefit to that family that's selling the home. You want to get them the highest price as possible. And who said that owning a home was a right in the United States of America, that everyone is entitled to a 30-year fixed mortgage going a couple $100,000 in debt, which is essentially a liability? It may not be the best investment. It hasn't been a bad investment historically, but it's not the best investment.
It's hard to say that there are homeowners that are making a lot of decisions about the values of the homes around them. You talk about HOAs or even just like these small municipalities where things like zoning agreements, and there are ways that they can exert their influence on the value of homes around them. There doesn't need to be an investor involved, and at the end, an investor is going to probably sell it to a homeowner. At the end of the day, someone's probably going to be living there, so it shouldn't really matter.
At some point, the market is a pretty smart thing, and you can't assume that you're so much smarter than the market and you can manipulate it in a way that's going to have a certain outcome, because there are so many variables and inputs. You end up having a lot of unintended consequences when you really start manipulating the market. Obviously, there's some things that you want to make sure doesn't happen, and you want to have clear rules of the road and all that stuff. But markets function for a reason, and you have to be careful. And that's where, when we've talked about rent control in the past, is essentially price fixing, and that can really wreak havoc on the market and make the problem.
But this is my last thing I'll say, is this would be kind of the nightmare scenario, and I think that this is why maybe people are scared, is that what if investors they really control so many of the homes in a particular community? Maybe it's it's a really desirable community, that they can essentially dictate the price of homes there, and they
still
really
market
lock people out.
But somebody's got to buy it.
There's
got to be a seller. You got to mark to market. You got to be
at the end of the day, someone's making their decision.
You can try to corner the market. I mean, Hunt Brothers tried to do it in silver in the 80s. Didn't work out for them. It's very hard to corner a market, especially for an industry as large as housing. Sure, in a particular market, but you still got to have another side of the transaction.
Well, and that kind of gets into the next article. Is there, and I mentioned this a little bit too. There are some serious decisions that are maybe driving the price of housing up, that municipalities, that neighborhoods make, that prevent denser housing, that that create more regulations that make it more expensive, that they have to follow these rules, they have to follow these things that prevent more houses being built, that I'm sure that 18% of investors would like a little bit more density, but I think that ultimately there are limits in a lot of different places and causes in a lot of different places.
I agree. So let's move on to this next article. So I think we've got it via SF San Francisco Gate, but I think originally came from the New York Times. The next affordable city is already too expensive, Matt. What gives?
All right. Well, last story was pretty great. I gave that one an A. This one's a little bit more narrative focus.
Fish out of water.
Exactly. There's usually this narrative anchor to the larger issues in these kind of articles. This one has a lot of these personal narratives, less numerical research really than the AP story, which had some numbers there and some really a broader picture to kind of back up. So this one begins with a story of a man moving from high cost Los Angeles to Spokane. Now, I remember talking about, is it
Spokane or Spokane? Spokane, I think.
I think Spokane sounds weirder, so that's why I think it's probably right.
I don't think Spokane. I don't think anyway, sorry.
I remember talking about Spokane last year. It was one of the areas where rents were so high in 2021, they kind of plateaued at an earlier point than other markets. That and Boise had this moment where it's like, okay, they kind of normalized, really. And now rents are just one part of the cost of living. and they're not perfectly correlated with single family home prices, but they're decent enough of a barometer to get a general idea of a priciness of a market, which is really what this New York Times article is about. And I have to say, if the title of the article is "The Next Affordable City is Already Too Expensive," I could think of a more affordable move than a move to Spokane. This really is a catch-up article, I think, for people not following the housing affordability crisis. And I may have said this even last week, is it's not necessarily a housing crisis, it's a housing affordability crisis. In terms of collapsing values, that's not what we're really seeing, but we are seeing these rising rents and rising home prices, and it's, again, due to demand, which we'll talk about. It covers a lot of this stuff, like I said, Boise, but I'm going to read this whole passage because I think that it has some pretty powerful implications. So it says, again, I have to stop here, is I told you how all these articles always start with a personal story, and then they go into say, like, Joe's story is the same across the nation. Well, this one is true to form. The story plays out locally, but is national in scope. It is the story of people leaving high-cost cities because they've been priced out or become fed up with how impossible the housing problem seems. Then it becomes the story of a city trying to tame prices by building more housing, followed by the story of neighbors trying to prevent it, followed by the story of less expensive cities being deluged with buyers from more expensive cities, followed by those descending into the same problems and struggling with the same solutions. It keeps going down, maybe Spokane, and then what's the next one? What's the next one? I think, if you are an investor, investors saw this coming, I'm sure, years ago in Spokane and in Boise. But I would be looking at that second and third city down the line.
Well, they were the affordable city, and so what happens, and where you go to next. That's where it's always interesting looking at those emerging markets. Yeah. And then when is the cycle kind of restarting? Because then you have to wait for the more expensive markets to get their rents even further up.
And that's why I've been so interested in these reports that we have from these like moving companies, but for Apartment List has these migration reports, is because we did see a slight uptick, not as much as people thought maybe, in mobility and in migration during the pandemic. But I think that the cause that they identified, this increase in prices, could be a really big driver if it really complements and compounds on the existing trends.
Like, I can't afford to live here anymore.
Yeah. And there's less barriers. I don't see, remote work as a huge factor that some people may see, but it may make it slightly easier and be a contributive effect.
It's easier to move. You don't have to be in that expensive location. It doesn't mean, I can move home, it's going to be cheaper, but I have to lose my job, I have to take a pay cut. Well, people are still taking relative pay cuts because they're like, they are taking into account the cost of housing these days. But.
Yeah. And I think that like I said before, there's another, just one kind of sentence at the end there. It's easier to change where we live than it is to change how we live. So if you've gotten used to this lifestyle and suddenly you can't live in the same place and support that lifestyle, then maybe you'll move somewhere else. I haven't really seen the numbers for that, but it is an interesting report. Like I said, this article is more heavy on the anecdotes.
You don't want to go. Usually, you like the idea of going to a bigger place, with a little bit more room. Trading up, not downsizing. Yeah, unless you had a big place and all your kids are old.
And another thing too that underlies this is not only is it getting more expensive in places, but then that next city is becoming, their amenities and the features of their city are becoming more more upscale. And we've talked about how suburbs and submarkets are becoming like mini cities. Well, some of these secondary cities are building out a lot of their lifestyle is starting to resemble the primary markets as well. So it's not like just one place is being growing. These places have been growing, and they kind of notice what's happening and what people are into, and so they're bringing that too.
Yeah, that's a good point.
The closing quote really. So I think it just makes it more important really to look at the long-term prospects of a market, analyze the factors behind its growth, and really determine how sustainable it is, and look for these stable cities maybe. I guess there are more variables at play here than the past years of rent growth, but this countervailing force of people moving to more affordable markets could become a serious consideration when doing market analysis. Now, the closing quote, and this is what I was kind of getting at, is this, there is maybe like a neighborhood, there's like a regulatory environment that in which existing existing residents are kind of against the change and against things that might make it more cheap.
Classic NIMBYs.
Yeah, exactly. And this closing quote, and you know, in the same breath, they'll say, "Oh yeah, I like this. I like this area, but just not from where I live."
We need more dense housing, just not on my block.
But not here.
Those types of people here.
Yeah,
exactly.
And I was listening to a podcast that said that attitude is actually present among renters as well, to a certain extent. So there is this identity effect. It's kind of not, it may not necessarily mean, because if it was denser, the rents would be lower. They don't have as much of a financial stake, but there's, I think, an identity effect that they want things to stay the same.
Neighborhood.
And I agree. Yeah. Where you live is a lot of parts of who you are. And it's going to be interesting to see how this affects mobility.
Don't like change.
Yeah.
People.
So yeah, like I said, so this closing quote says, the guy says, "I have nothing against duplexes and triplexes, just not next to my house. You know what? If duplexes and triplexes are seen as changing the fundamental character of a neighborhood, then Spokane's housing affordability problems are going to be difficult to resolve." I've seen some pretty nice duplexes and triplexes drive around that they fit in. You can kind of barely tell. And to think that that's where he's putting his bar is
that's the
very,
line. That's the line. So you're not going to allow a 200 unit.
Yeah.
5-story podium.
And I've seen this on in other forms, is like, you keep worrying about those duplexes and triplexes, you'll eventually something may come along that really does change the character of that neighborhood. And because you were focused on those little things, you're gonna miss it. You're gonna miss the real drivers of what, all of a sudden apartments are so expensive. So
as they are, although it's tough because we keep thinking things were expensive, and then we see numbers come out and growth, and the numbers kind of make sense, and sometimes they don't.
Yeah.
And then it's like, when you're getting the information and the data, plugging it in, where it's going to go, and forecasting this stuff is very difficult.
I was thinking a lot about that, and especially when I was going over this next article, is what kind of guarantee. I was thinking about developers and like, what are they thinking? They look at the numbers. You can't just go by numbers. It's like, okay, we got 5% vacancy here. We got 80,000 absorption or whatever the number is.
Well, you do, but it's like, okay, these are the numbers we would usually use, but now it's like, okay, maybe these aren't right for right now. Do we use our long-term historical averages? Do we use the new average? Does the trend continue? Does it revert?
Yeah.
There's so many different directions, and there's opportunities to make mistakes on either side, and you have to thread the needle, because if you are too aggressive, obviously you can pay too much and get over, you can get ahead of your skis.
Yeah.
But then you can not factor in as much growth and just not buy any deals, and just you're not participating. So you have to thread the needle, and that's hard to not overpay.
Yeah.
So get a good price when all of the whole idea of looking at apartments on a price per unit or price per pound basis, it's like you have to. It's a mental exercise to try to filter out and remove the emotions of thinking, relating price per unit to previous deals that you've bought recently, year, last year, 2 years ago, and saying that prices have gone up so much. We bought that property, Suncrest. We bought it for basically $100,000 a unit, mid 80s, and now similar vintage properties are trading now in like the mid 100,000s, like 150,000. Yeah. I mean, we were just going after a mid 90s deal that was trading just under $200,000 a unit. The average unit sold in the U.S. right now, I believe, is around $248.
Yeah, it's pretty expensive.
And year and a half ago, we bought a deal for $50,000 per unit.
Yeah.
And in December, we bought one for $114 a unit. And now that same deal is going to go for $190. And that's supposed to be a good deal. But, okay, well, rents have risen 20, 30%. You put a cap rate under it. Okay.
Yeah.
I guess it makes sense. Occupancy is up. How long can this continue?
Well, that's
does it revert? Does it continue to grow? There's
I keep thinking of worst case scenario. And you've another note with Noah Stone, and he's measured all these environments, and it's hard to find a worst case scenario. And I keep thinking of kind of on the individual level. It's one thing to look at the broader trends, but I keep thinking about that again. This apartment developer that builds it, and then what is it that makes him or her know and be so sure that maybe they're not going to, maybe they build it and they won't come. Maybe it'll stay empty. This is
what they're doing.
They're sticking their fingers in the air.
Wetting my finger and I'm sticking it up, and which way is the wind blowing? And
yeah. Well, and
nobody knows that. Yeah. Like, and anyone who says that they know doesn't. We don't know. We can make certain assumptions, and we can have a good feeling, and we can see things. And I see a direction things could go, but we don't know for certain.
Yeah.
So at some point, you have to take a leap of faith, and this relates, because I think a lot of people maybe listen to this and they're saying, "I haven't done my first deal." What you guys are talking about, I don't really understand what you're saying.
Yeah.
What this really relates to is doing things that make you feel uncomfortable are oftentimes still worth doing.
Well, those are maybe the valuable ones.
They're really all the biggest things, the best things that I've ever done have been very scared to do, and it leaves you with an uneasy feeling. But those are the deals that end up working out because you're pushing yourself to that next level. And so if you haven't done a deal, if you're doing one deal and you can't make sense of things, everyone is in the same boat as you, and you'll never know everything. No deal ever is going to look perfect or a home run. But at some point, you have to make that leap of faith and say, I've done all the diligence I can do. We'll never be able to do 100% of diligence because just you never can know. You can't know everything. You only have so much time and resources and information and money. You have to make a call.
Yeah.
Are we going to go? Or are we not going to go? We made an offer on best and final yesterday. Made me nervous.
Yeah.
It seemed expensive. Now, someone overbid us. But we put it all out on the table. I was confident with the value where it was going to go in the long term. Or did we have to, speculate a little bit? Like, sure, but we know stuff going on in that area, in that market that other people don't.
Yeah.
We ended up not winning, but made us a little nervous. If we would have won, it would have been good. And we think that we made a good impression with the broker and the seller by doing what we did. So do the thing that you think is right, even if it's going to make you feel uncomfortable. If it all feels like just a no-brainer, then honestly, the no-brainer ones are the ones that kind of get you in trouble because like you don't look at everything the right way. You don't stress it as hard.
It's like that when someone's working around dangerous machinery, they'll get in an accident when they have a lot of experience, when they're jaded and they're not taking account of the real risks.
Exactly.
So
fascinating times.
One of the and I'm going to try this segue here. I think when you're thinking about apartment demand, it's one of the things that I think about when I'm trying to consider whether a project is worth it. Do I talk about supply and demand? Previous weeks we talked a lot about apartment supply and how there's not enough of it, and we've covered it just a few minutes ago. But I think that this report, even though it was published about a week and a half ago, I think it's really one of the favorite ones that I've come across this week. The report. The headline in this report is that apartment demand on a national level has come down from a peak 263,805 absorption in Q2 2021 to currently 69,667 in Q4 2021. So again, that's a big decrease from the peak to Q4, and it frames it though not as a catastrophe and not as a horrible event, but as a normalizing of demand. And I would agree here with them, not really characterizing this as a cooling off period. Outside of Q4 2020, the absorption numbers for last quarter are higher, and you can see this on this chart here, on the chart they have on the report. They measure it by quarter, and you can see Q4 2021 is higher than any Q4 measured as far back as 2011, and likely even further. That's just where the chart ends. So this is an above average Q4. It's just not at the huge heights of the absorption in mid 2021. Now, on the topic of long-term vacancy trends, I'd like to talk a little bit about the vacancy rates on the national level. Vacancy is the percentage of all available apartment units that are not occupied.
Correct.
Okay.
Yep.
Now, vacancy is low, and I think quite low. It differs on what source you're using. On this chart, it says 5.6. CoStar says it was 4.5 last quarter. And looking at the historical trends, you can see that vacancy has been going down steadily since it peaked in third quarter. Third quarter 2009. Yep. And so
because we stopped building.
Yeah.
We were building up until then, and then we stopped. Essentially, it trickled out a little bit, and we never got back to delivering what we needed.
And it is interesting also looking at kind of the size of the jumps and what you can kind of expect, because I'm always really thinking about like the worst that could happen, or really the ways that things could fluctuate, the volatility of the market. And looking at this, and this is just from my own kind of back of the napkin, the most dramatic yearly rise in vacancy rates was a 1.4 increase from Q4 1959 to Q4 1960. Now there could be more, but that was a particularly dramatic one. That's just kind of, you can use it as a hallmark of this is the worst it could get if we're talking about increasing vacancy. Then there's also a 1.2% spike in 2002, 2003. These are rare events that vacancy is not going to spike that hugely. Even if it does, though, so we're at 5.6. Let's say it does have a 1.2 spike. In this wild and kind of worst case scenarios, vacancies could increase to 6.8. And here's how low 6.8 vacancy is historically. Again, vacancy has been on a downward trend since 2009, but let's look at 2015. That was the kind of, that's a good benchmark there.
Yeah, so 2015.
2015,
7%.
7%, 6.8. So if you look at that, 6.8 in Q2 2015, and then if you kind of move backwards from 2015 Q2, you've got to go all the way back to Q4 1985 before vacancy would be that low. In those 30 years, vacancy was never under 6.8%. So you can see that kind of clear trend of vacancies going down in 2009, and it does lead me to think, are we at this low point?
Well, and looking, in the 1970s through the mid 80s, which was a period, well, at least the late 70s and the early 80s was a period of high inflation, basically relatively stable occupancy and vacancy, basically through the late 60s through really kind of the early 80s. Kind of hovered in between, at least according to Fred, which they're not always looking at the same metrics we are, but kind of between 5 and 6%.
That's what I was. That's what I kind of marked too. There's that stretch really of 15, 16 years
in this period. Just thinking about demographics, you have the baby boomers in this period who are entering their prime home buying age, kind of in the mid 80s, family formation years that are not renting as much. They are buying homes, having families, this huge generation. And then what happens in this period? Well, we stop building because we've been building throughout this period, but also that happens. The next largest generation starts becoming renters, and that would be the millennials. And the millennials start just bringing this vacancy rate down, as well as homeownership rate decreasing, housing affordability, just widening, less supply. We're still not building enough. And now the baby boomers are moving out of those homes, renting again. Now the millennials are trying to take their place, but a lot of millennials can't actually afford those homes.
It is interesting because before I looked at this report from NAR, I thought maybe that the cohort of millennial growth would be the largest cohort that kind of rents and growing. But you look at household formation, and it seems like the numbers of retirees is where you're seeing the household formation growth. At least in the past year. And it does seem like those
it's the great resignation.
I think that it really could be, and I think it's very interesting. I'm not sure how resilient these trends are, because sometimes household formation is really big, and then for some reason in certain years it's just really small. So I'm not an expert to explain that. I do think that it is a very I would believe it. I believe that thesis that people are retiring, people are going and renting, and this is the cusp of a big shift among baby boomers. So so we talked about this long-term trends in vacancy. I do want to touch on not demand itself, because I talked about what, if a developer or an investor just relies on those numbers of absorption and demand, I'd be a little nervous. Like, there's no way to put that into context. But NAR gets at a little bit what's driving this demand. And I thought this was actually particularly interesting. And it talks about how one of them is this turnaround in net household formation. In 2020, it was negative 128,000. In 2021, it was positive 1.48 million.
Yeah.
Now, this is roughly the same amount as household formations in 2019 at 1.44 million. But again, it's at a steady, really elevated level.
So Matt, you're throwing a lot of numburs out.
Yeah,
a lot of statistics.
That's true.
You've lost me. So someone who's new to real estate investing, what does all this mean? Because household formation, supply and demand, it's getting wonky. How does someone who's trying to get into multifamily investing, should they be focused on absorption numbers and supply and demand, or should they be focused on how to underwrite, the basics?
See, I think you combine, you kind of really do have. It's not an either or. I think that you got to look at the numbers and you got to look at the story behind the numbers as well. And the better numbers you get, the better stories you get. And the story is really just the kind of logical connections between all these numbers, what the context is, what the kind of reasons behind these numbers, and the one thing that the NAR wants really is speculating on that I think is worth mentioning here is they say that people moving back to the workplace is having a positive effect on absorption, has a.
So I can see it being a whole new cycle of formation of people being like, okay, I moved.
Exactly.
Once for the pandemic, now I have to move back.
So everyone's thinking, maybe remote work is driving rents up and, driving housing demand. But this moving back to work, we could find maybe a singular wave. But I think that's definitely something to watch. And it was interesting because it kind of diverged from a lot of the other arguments that people have used. So
the best way to stay on top of all of this stuff and to be able to kind of follow what we're talking about, and if this was over your head, that's okay. See this as a primer to trying to dig into the data. But the best resource, Matt, is grayreport.com. If you're already subscribed to the Gray Capital YouTube channel, you're going to be subscribed to the Gray Report. So make sure that you're hooked into the podcast, Gray Report podcast. But grayreport.com, we are aggregating all these reports and it's being updated daily. And so if you want to really stay on top of the market, bookmark grayreport.com, and then obviously the newsletter every Thursday. If this seems intimidating, sign up for the newsletter, graycapitalllc.com/newsletter. Every Thursday morning, you're going to get sent a bunch of articles. If you spend a couple minutes each week going through those, you're going to really get up to speed very quickly, and you're going to be much more informed to make better investment decisions, whether you are you're a syndicator, you're raising capital, you're trying to put your own deals together. You're really going to be able to communicate with investors intelligently, and you're going to be able to really forge the right investment strategy and decisions. If you're a passive investor, you're going to have the right knowledge to find the right opportunities. If you're working in the multifamily industry, you're just going to have a leg up from everyone else. So it's a critical tool. So highly encourage, subscribe to the Gray Capital YouTube channel, the newsletter, and of course the podcast. And then one last thing, again, this episode is sponsored by the Gray Fund, a multifamily investment opportunity fund sponsored by Gray Capital, only open to accredited investors. We're raising $100 million, going to buy about $300 million worth of multifamily assets. So if that's the type of strategy, mostly in the Midwest, if that type of strategy is of interest to you, just like to learn more about it, pop over to graycapitalllc.com/grayfund to learn more. All right, Matt. This has been a great episode.
Thank you.
Catch us next week. Appreciate the insights, Matt.
Thanks.
We'll leave it next week, guys. Have a good one.